You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome back to this week's edition of the Systematic Investor Series with Jerry Parker, Rob Carver, Mark Ryszymczyński, Richard Brennan, Moritz Siebert, and I, Niels Kostrup-Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. Today we're back with part 2 of our very special episode where we are all together for one big conversation and debate. As you know, this podcast series is all about voicing our differences on the one topic that brings us together, namely systematic investing, using the often overlooked but very robust strategy of trend following. We're recording on December 15th, and this conversation and what you're hearing right now is the second part of this mega recording. So if you missed part 1, then make sure you go back and listen to that one first. Okay, so we got through the first few rounds in last week's episode without too many bruises. So let's continue to dig into all of the topics that we each brought along. But before we do too much digging, I want to throw in a quick lightning round here where you have to do a quick sort of choice between two options, and I'm going to read you the choice just to hear your kind of thoughts on that. And that is, would you rather trade 100 markets with one systems using 10 different timeframes, or would you rather trade 50 markets with 3 different systems using 5 different timeframes? I'm going to start with you, Jerry. What are your choice?
I'm always going to choose more markets. 2 systems is more than enough. 2 systems is enough. I could trade a lot more, but yeah, more markets, the better. How can I hunt outliers if I'm not trading as many markets as possible? So that's going to dominate my performance, even if with multiple systems, 5, 10, 15 systems, it may not handle the outlier optimal. One of my, the perfect parameter to get out of that thing, to maximize the profit may not even be one of my systems, but I'll take it. I won't maximize the profit necessarily, but at least I want to be in as many markets and as many outliers as possible.
Okay, sure. Mark, what's your choice? More markets or less markets and more systems?
I'll take more systems and take just the opposite. And I always sort of think in terms of there's 3 levels of diversification, and I use the term STM. You want style, timing, and markets. So if I could have more than one style, couple timing, different timing periods, and then markets. And in some sense, I'll trade off and take a little less markets to get more of that style diversification.
Okay, cool. Rich, what are your choice?
I know this is sacrilegious, Jerry, but I'm just thinking in this current environment, look, I personally think that diversification is never enough. So I hate this question because it's forcing me into a little sort of corner of the room. But I do like system diversification because it gives me entry and exit correlation benefits or uncorrelated benefits in relation to my systems. It also allows me to attack different segments of these outliers by applying different systems to these non-linear features in the market data. So, we might have an outlier that lasts for 2 years, 3 years, and by having these multiple systems, by having a single trajectory over that outlier, you're defining a trajectory of probability over that landscape. I prefer to attack that outlier with multiple different variations of trend following system to capture different segments of that outlier and give me a degree of sort of correlation benefit there. So yeah, I hate being put in this corner. I'd like to say I'm totally with Jerry in diversifying across markets. However, because you forced me here, I would say that. But yeah, I don't negate the wonderful benefits of cross-asset diversification.
That's the most hedged answer I've ever heard, Rich. Anyways, fair enough. You got away with it. Moritz, I have a feeling which camp you're going to fall in, but let's hear from you.
Yeah, I have that same feeling as you, but let's see if I can surprise you. I'm definitely in the 100 markets camp, but let me try to explain why that is. I'm assuming that I can really get 100 different markets. If they're all from the petroleum complex, then that I would change my answer. But let's say we really have 100 different markets, then that to me is extremely valuable. It is immensely valuable for my trend following trading system. And I will get more benefit from these different markets than I would get from having more and more different types of trend following systems. So if I do a moving average system, a breakout system, a regression-based system, whatever that may be, it will add some diversification on, here and there in a given month. But over longer time periods, I'd say they all produce trend following returns. So they're kind of like similar in what they do. So let's just say I'm doing a breakout system, and I'm absolutely fine with just that one system. And I will then get diversification by trading that system, which I keep intact and unchanged, across different timeframes. There's some diversification there. But if you do 3, 4, 5 different timeframes, that is already pretty good. I don't think you need 20 different timeframes. That is too much. I mean, I think that's adding too much complexity. And I've reached peak complexity, so I want to get down from that mountain and simplify it. But the 100 markets, if they're really independent and uncorrelated, that is worth a lot of money at the end of the day. And therefore, I'm in that camp of 100 markets.
Yes, no, you didn't surprise me, Moritz. That's also where I figured you. So we got a 2-2 tie at the moment, Rob. Where are you gonna? You're kind of the decider here.
Wow.
Where are you gonna
fall? A lot
fall?
of pressure. I must say, you guys don't really understand what quickfire round is, do you? But anyway, I guess we'll edit your responses down to simple yes or no. So the answer is it depends. So if I'm going from 50 to, well, it depends on the question. The question's not clear. So I'll ask you straight out: am I these extra systems? Are they all trend following systems, or am I allowed to add other kinds of system?
Oh, that's a tough question. We are in the
Strictly
trend following world. Yeah, we are in the trend
if
following world.
if the extra systems are trend following, then I would go with more markets. If they weren't trend following, if I'm allowed to add something like carry or something like that, then I think the benefit I'd get from doing that is greater than the benefit I'd getting from going from 50 to 100 markets. Which, because the extra 50 markets, they're going to help definitely, but they're there's already probably quite a lot of diversification in the 50 market portfolio. So I think I get more benefit from additional systems. Within the question as it's asked, I'm on the market side.
Well, it's good to know that you're on the side of Jerry on this one, Rob. So
just this once.
Fair enough. All right, we're going to go on to the next sort of round.
Niels, that doesn't excuse you from having to answer that question. What do you prefer?
Good point.
Okay,
he's
so
going to
I
hedge
think
himself.
No, I'm not going to hedge myself because I've kind of voted already. You could say, by the way, the trend following model that I talk about every week is designed, and it does have it has a bit more than 3 different systems. So I have to stay true to that and stick with the 50 markets, 3 systems, and 5 different time frames, even if I don't use 5 different time frames.
So we do have a tie.
3-all.
3-all, yeah. We've still got a tie.
Of course.
There's only one way to settle this. Listeners at home, you can't see this, but I've just got out my boxing gloves. So we'll just go out and settle it like men, yeah.
Absolutely. Well, let's move on to a topic that Mark brought along, and it was actually related to a topic that Rob also asked about. And it's somewhat related to actually a conversation that Rob and I had recently with Cam Harvey a couple of weeks ago on the podcast. Now, Mark wrote, he calls it the skew question, which is a very good way of describing it. I cannot eat skew, only return. I can feel when volatility increases. How do I feel an increase in skew? And then Rob came along and said, just how much positive skew do we need? Inspired by our conversation with Cam Harvey. What is so great about positive skew? ? I guess investors like it, and it provides a hedge against negative convexity assets elsewhere in your portfolio. But in isolation, if you didn't have to worry about those things, all right. So maybe I'll start with you, Rich. Actually, since you didn't bring up this topic directly. So, how much skew do we need?
Well, see, I view skew as an outcome of a process, a bit like returns. So I don't view skew as something I assess on a day-to-day basis. It takes 1,000 trades or more to sort of get this feeling for whether your trade distribution has positive skew to it. But it certainly over a large data sample tells me the efficacy of my process or the efficacy of my trend following models if I get this positive skew. So I think it's more important than the short-term daily basis to look at things that contribute to skew, like what is your average loss? What is your average win? What is your current win and current loss in association with these historical averages? So if you find that you've got a linear sequence of small losses and you get these occasional very large wins and your return to risk is very high and your win rate tends to be fairly low, that ticks the boxes that the outcome I'm going to achieve over 1,000 or more of these trades is going to achieve this positive skew. But it's an incredibly important aspect for trend following because this tells you, the skew basically tells you the direction to which it's either beneficial. So that's why when I use the term positive skew, I'm thinking of a positive thing, a beneficial thing. It tells me that in the sort of uncertainty where you get sequences of these very large skewed events, it's towards the beneficial side of trade distribution. If we have negative skew, that's a negative thing to me. So that tells me the direction during uncertainty is a potential sequence of very large losses. So for trend followers, it's all part of our risk mitigation that we naturally, therefore, inherit this positive skew because we're cutting losses short and letting profits run. That philosophy, therefore, ensures that over a very large data sample, we get this positive skew expressed by our trades and it consolidates into our monthly skew, weekly skew, or whatever. So the important thing for skew for me is it tells me where the non-linearity and the linearity reside in my distribution. So negative skew tells me that the non-linearity is towards the adverse side of my trade distribution, and the linearity, the number of small wins, is to the positive side of my trade distribution. That's bad for me. But positive skew tells me that the non-linearity, the beneficial uplift or the step-ups in our equity curve, is to the beneficial side of our trade distribution. And the linear sequence of small losses means that only in events such as Black Friday and only in events such as March 2020, when we suddenly get this massive correlation across all asset classes, normally our losses are linearly distributed as opposed to non-linearly distributed. Our profits are non-linearly distributed. So that's how I view it.
Yeah, no, I want to hear your thoughts, Moritz, on this one. But I just want to interact one thing or insert one thing, and that is, I mean, are we, or not we, but are investors who want us to also now have a certain profile in terms of skew? I mean, are there just too many wishes that we have to live up to in terms of being trend followers? We have to have a certain profile. And is there a risk that actually if there's too many of these things we have to live up to, we kind of lose the origins of trend following, so to speak? Moritz, what are your thoughts on this?
I like the skewed outcome distribution that we have with trend following. I cannot eat skew, but I know it's a good thing for me. Think about the opposite. Invert the question. If you had negative skew, then you kind of like in this probably steady flow of small returns trickling in every day, every week, and then all of a sudden you have that nasty surprise and you're taking out a business potentially, or you have a massive loss. I don't want to be in that situation. I really changed my mindset to be absolutely fine to work with messy markets day in, day out, and take it on the chin day in, day out, but eventually hit the home run. And that is a different type of trading. I think it's a different style. Most people don't like that, as we know. We know that from prospect theory, from Kahneman. It's kind of like it goes against us. But I don't think that comes overnight to anyone. It is something that you need to really get into your brain, get it chiseled in. And you can only do that by doing live trading and trading for a long time, I think. And then you can get there and just accept that.
Yeah.
Therefore, skew to me is, I know I have a positively skewed return distribution. I'm very happy about that. But other than that, yeah, I don't really calculate my skew number on a weekly or monthly basis and see if that has changed. It is not meaningful to me.
So before we get to Rob and Mark, who brought these topics up, I want to hear from you, Jerry, if you don't mind, on this topic.
I love this topic. So I think what Richard was saying is pretty darn scary. Yeah, do you really want? That's why I would stay away from convergent negative skew. That's why if given a choice, Rob's question, if given a choice, well, if I'm given a choice, I'm going to trade all trend following systems because I don't like what I hear about possibly not being able to stay in the game if it's negative skew. But this is another example of how classic trend following got sort of, trying to be nice here, polluted by these ideas of sharp and vol targeting, in the sense that it's not, I think that the skew needs to be looked at from the trade distribution and not the performance return equity curve, because that's going to make you want to vol target and get rid of the benefits of trend following. The trend following equals positive skew, taking small losses and letting profits run. Black Friday wasn't a bad day for trend following because trend following doesn't pay attention to skew. Is not, the equity curve is not, you don't measure skew by equity curve. All those trades that sold off in my portfolio were huge winners. They had tremendously positive skew. So that was just letting profits run. So I think focusing on what's going on with the equity curve and trying to put skew into that, once again, leads down this path of, well, I've got to pay attention to returns. I've got to cut profits short. I've got to vol target. And it takes away from what trend following is all about.
I can see Rob is jumping for joy, or maybe not for joy. He's got his boxing gloves off again. So before we come to you, Mark, I think we need to let some of that energy out of Rob on this point.
I mean, I've made this point before, but I strongly disagree with the idea that we should be measuring characteristics based on trades rather than based on, say, daily returns, because what you actually experience are the daily returns. And the interesting thing about skew actually is it changes depending on whether you measure it on daily returns or monthly returns or even annual returns. And in fact, trend following systems, unless they're very, very fast systems, will not necessarily have positive skew based on daily returns. But only once you move to monthly returns will you start to see them. But anyway, I've mentioned it before. I just have to, mention it again as Jerry's brought the point up. So I think going back to my original statement about why people like skew, my ex-boss used to have a wonderful statement, which was this: running a positive skewed strategy is an unpleasant experience, but it's easy to risk manage. Running a negative skewed strategy is a much more pleasant experience, but it's harder to risk manage. And it's much more pleasant because basically 98% of the time you're happy because you're getting those positive returns. But it's a pain to risk manage because, you've got those big sharp negative drawdowns. You don't really know how big they're going to be. That steady stream of positive returns encourages you to, that's a situation where using something like Sharpe ratio is definitely very dangerous. I absolutely agree with Jerry there. Because, the Sharpe ratio of these negative skew strategies looks fantastic. And then you're encouraged to, the standard deviation of risk looks very low. And you're basically then encouraged to leverage them up. And on the assumption that the worst drawdown you've seen in your back test is the worst drawdown you're going to see in the future. Guess what? It's not going to be. There's always going to be a worse day. And when that happens, if your leverage is too high, you are definitely going to get wiped out. So that's what I mean by negative skew strategies being harder to risk manage, even though they are on a day-to-day basis a much more pleasant experience. Going back to my original question, how much, so for me personally, I wouldn't kind of grab as much positive skew as I could, because there's a trade-off. And you're always going to be giving up something if you get more positive skew. So for example, I'm not someone who would exclusively trade, say, a strategy that bought out of the money straddles, an option strategy, because that's a strategy that has amazing positive skew. It's a superb positive skew, but it's also guaranteed to lose you money 99.9% of the time, and indeed lose you money over time. So, I'm not happy with that. On the other hand, would I trade a strategy with a Sharpe of 10 with massively negative skew? No, absolutely not. I'm not happy with that either. I'm somewhere in the middle. We're all somewhere in the middle. It's just a question of where in that continuum we lie between those two extremes. Everyone's preference is a bit different, I guess. I probably lean slightly more towards I'm happier to have less positive skew in exchange for some other benefits than obviously some of you guys.
Actually, if I can just mention something, because I think Robert has mentioned an excellent point here, which I'm not sure if we touched on that ever on this podcast, but the positive skew that we're all talking about, and Rob has said that very correctly, it doesn't show up in the daily returns. If you make the time frame more granular, if you looked at intraday returns or any of that, the positive skew goes away. You kind of like see it when you look at end of month returns. You will see it if you look at quarterly returns. And when you then do a best fit, like an exponential spline or something like that, you see that thing starts to smile. And that shows the skew, but you don't experience that positive skew, as Rob has said, on a day-to-day basis. It's not there. It's not something that you can take to bed and be happy about. It's an artifact. It's a product that you can only realize and see at higher time frames, slower time frames. But that there is positive skew is kind of like, what Jerry's favorite saying, which I absolutely love: one entry, one exit, one stop loss. With the initial stop loss being so important because it keeps the losses small and it keeps the upside open. That produces skewed returns, right? Because it forces the distribution into that thing where, there is a very large body of small losing trades. But like with a call option or a put option, it's the option premium that you pay to play. And in return, you get an unlimited upside with your trade, which produces the non-normality of the distribution. And that's what we're talking about. But you don't see that on a daily basis.
No, that's a good point.
All I would say there, though, is that fundamentally, you would look at skew at the trade-by-trade basis, because all sort of daily, weekly, monthly consolidations of that trade history are basically artifacts of that fundamental nature of skew that exists in the trade distribution itself. So, I'd tend to sort of side on Jerry's side here and say fundamentally skew is embedded in the daily trades, and how it's consolidated in the daily, weekly, monthly. That's sort of window dressing or just a different way to change that distribution through the method of consolidating your losses, sequence of losses, and your major wins.
I want to hear from you, Mark, but before we do, I just wanted to say that I obviously understood Rob's answer, saying he wants to be somewhere in the middle, as he was going to choose kind of a sharper 5 with positive skew, somewhere in the middle of what the extremes were, but there we are.
If someone has a sharper 5 and positive skew, please tweet me now, and I will give you all of my money.
Mark,
they won't, because they're trading that stuff themselves, as they should.
Or Madoff.
Exactly.
So the reason why I brought this question up, because it really is very complex. I think that we love and we are very good at articulating the skew narrative, that we can create option-like payoffs. We create nonlinear payoffs. This is that we'll have small losses and large gains. And then what you do is you go into the data. And let's say you look at your monthly data, and then you have to, and you can, run the statistics, because it's the third moment of the distribution, without getting into the weeds, and you get a skew number. And when you look at the moments of the distribution, you always love mean, which is the first, you always love the odd moments of the distribution, which is the mean and skew, and you hate the even moments of the distribution, which is volatility and kurtosis. But then you go out there and measure it, and then you get a skew measure, and then you show it to a client and say, well, I've got slightly positive, and here's the S&P, and it might be slightly negative. But, it's very hard to sort of say, like, well, what does that mean? And if I give and then if you look at the significance of skew, as a statistic, it's oftentimes not significant. And there might be small differences between what is a slightly positive skew or more positive skew. What does that mean? And how do you translate that into numbers so that you can explain it to a client? And I find that very difficult. So I think we always talk about the skew narrative, and people, resonate with that, which on a trade basis, it's I hang on to my winners, I sell my losers, I create option-like payoffs. and then you look at the actual numbers, it's harder to then translate that into a number and say, well, this is good skew. So I guess I'd sort of say that there is an issue of trying to convert that into a number that you could talk to clients about.
Partly because I think it's incorrect to use portfolio return as skew. It's not skew. You need to look at the trades, individual trades.
Right, but people don't buy trades; they buy your portfolio, Jerry. So if let's say if I invest with you, I give you money and I get the bundle of all that you do, and that's what I'm actually receiving as an investor.
Yeah, I agree, and they buy my expertise. But the reason that closed trade equity and trade skew and trade distribution is not used is primarily because the information is not readily available. You can't download it from a reporting agency that gives monthly returns. So we're going to use what we have, regardless of if it's good enough. So that's, I think, a little problematic. But I would just say, in commenting too, that I asked Richard about this on a podcast or on Clubhouse once, and so I, instead of maximizing my skew, which I think I could have maximized it by taking smaller losses, 2 ATR. For instance, the old turtle system, 2 ATR. I sort of optimized for profit and came up with a much larger average, loss in terms of ATR. And so I would definitely, and he said that was okay. So I continued to do that after having done it for 15 or 20 years. So I think I would sort of optimize for a better performance versus optimizing for skew. But it's like you said, skew is just this outcome, this characteristic after having decided how you're going to set up your system.
Okay, no, very interesting actually, and a great point to bring up. I think the next one is also quite interesting. We obviously, this came from you, Jerry. It's something we've talked about in different ways. But you brought up a good point, and that is that CTA diversification is not for the usual reason, namely diversification of risk, but for the hunting of outliers. So we're back to these outliers. Diversification is appreciated and reduces overall risk sometimes, but it's primarily for increasing the chance of finding outliers. Trading subsets of sectors versus all the markets in a sector is risky. CTA shouldn't stress too much over correlation. So why don't you maybe throw in your views on this thing where we kind of turn the whole thing around about diversification a little bit on this one?
I'll just say that before Mark takes off, I plagiarized this from Rich totally. This is what Rich has taught me since I met him over on Clubhouse and podcasting. So this is his idea. I think it's fascinating. And I remember Richard Dennis never talking about like diversification in the terms of having a smooth portfolio. It was just always like, let's just trade lots of markets and it'll be a lot of currencies and a lot of bonds and commodities and they'll be correlated. And it's just this total sacrifice to the god of outliers. And look, I appreciate diversification. It's wonderful. It's great. I have it. I have shorts on. We have more diversification than any other hedge fund category out there, but it's for this reason. And we trade WTI and Brent because something can happen in one of those two that's not going to show up in the other.
Right. Diversification is very different when you're running a long, short portfolio and you're constantly trading. And I think the hunt for outliers is a variation on the theme of talking about divergent trades. This is that by very nature, if you say, I'm looking for divergences in markets, I'm looking for mean fleeing activity in markets, those by their very nature are outliers. But when you talk about the hunt for outliers, is that the hunt is not easy. There aren't going to be that many outliers. And I could sort of say that when you look at through a lot of systems, you could trade a lot of markets, but a lot of times your profits are going to be sort of concentrated in just a few trades. A lot of your trades are going to be, we'll say the majority of your trades are going to be small scratches there's going to be some losses that because you hit your stops, and then there's going to be a few of these very large returns. But the hunt for outliers exists because they don't happen that often.
Yeah. Rich, I'm going to come to you last because you kind of is the godfather of this idea and concept. I want to ask you, Moritz, have Rich's idea of diversification, if we put it this way, has that perhaps also changed, like Jerry, your way of thinking about diversification, or did you always think about diversification as that, opportunity set increasing in your hunt for outliers?
Both. I first of all, I must congratulate Richard for coining that outlier narrative and really producing that, which is, when I look back at 2021 as we're getting close to the end of the year, is actually one of the things that I remember for the year. I found it really cool, Rich, that you came up with that. It's absolutely true, nails it. And we had those years where other terms were produced, such as, remember, crisis alpha, and we had the year where it was convergent and divergent. Convergent and divergent, by the way, I like. Crisis alpha, I dislike. Now, I used to like that a little bit, but I dislike it now. The outlier narrative, I think, is fantastic. I like that forever. So this has made my year better. I trade these markets, yes, because I do want to find as many outliers as I could possibly find. But I also don't want to disregard diversification. I mean, I can only maximize the chances of finding outliers if I'm trading independent, uncorrelated markets. So there you have the diversification element. Those markets need to be uncorrelated. A diversified portfolio of many different markets. That is what's increasing my chance of finding the outliers. That's what I want to do.
Cool. Rob, and I'll come back to you, Jerry, in a second. Yeah, Rob, what are your...
Yeah, I mean, it's always important to bear in mind that the ideas like correlation and sort of the classical idea of diversification are all based around linearity. So, the math, it makes the math nice and simple, because if you assume that you've got a whole bunch of assets with some correlation, you can very easily say, what the benefit will be from allocating to a basket of those assets rather than to, just say a few. And it goes back to the discussion we were having earlier about, is 20 stocks enough? Stocks kind of tend to move, in sort of linear ways a lot of the time. You're not going long short, so the correlation structure is very different. It's a lot more linear than what we're dealing with, because we're going long short. That's where you get this non-linearity from a lot of the time. So it's definitely the case. I mean, so I myself have spent a lot of my time this year trying to get to the point where I can trade those 140 markets, so I can have that ability to hunt for those outliers. It's definitely but the nice thing about the argument, for me at least, is actually it works well in both worlds. So even in the linear world, diversification makes sense, and the non-linear world, diversification makes sense. Yes, the reasons might be different, but the fundamental difference, I think, is that the benefits you get from going, say, from, if you've got one future in every asset class, so say you've got 10 futures, and if you then go to 20, 30, 40, 100 futures, the benefits reduce in linear space. The benefits reduce by the square root of the number of assets you're adding as an absolute maximum. And that would be if they all had zero correlation, which isn't usually the case. So you get to the point where going from the question we had earlier, going from 50 to 100 markets, the absolute most you can gain is 41%, because 1.414 is the square root of 2. And in reality, it's more likely to be a 15 or a 20% gain. But that's all on the assumption of linearity. The moment you move into non-linearity, you could say, well, I've chosen these, say, 7, 10 markets, but those, as Jerry says, those might be the 10 markets where in their sectors where nothing happened this year, and you missed completely the markets where things did happen, because of this non-linearity. So yeah, for once, I think I'm on the side of Jerry on this one.
Jerry, you wanted to add something?
Yes. I cannot believe I forgot about another topic I would love to bash, which is crisis alpha. How was that not one of my questions? What a horrible thing. But not only hunting outliers. I mean, he added to our animal collection, cockroaches, turtles, and then recently spiders. What a great analogy that he had in that podcast about spiders. I mean, it was amazing. I loved it. Another great thing, about you can trade a bit larger. I trade 5 units, whatever that means, but I can trade probably a bit larger the more markets I trade. That's kind of a money management scientific thing, I think. The more diversification you have, you can trade a little bit bigger. Uh, Another thing that happens when you trade, I trade 130 markets, is that even if I screw up and trade WTI and crude and it's 99% correlated all the time, it's such a small part of my portfolio, it's really not going to show up. And so that's another great thing. I care about diversification and correlations, but there's a lot less worry when you trade so many markets that if I just messed around and tripled my crude allocation, it would hardly show up on a daily basis or on any basis, unless there was a big outlier, of course. So that's really nice. I sleep so well at night, knowing that I trade all these markets so small that nothing is really going to be that material unless it really, really goes a long ways.
So after all that praise, Rich, and I'm sure Rob is already contemplating changing the title of his next book to Hunting for Outliers. What do you say to your new fan base here?
I love it. Keep it coming, guys.
Send me a T-shirt.
Rich, and Jerry, could I ask you a question? Is that if you're hunting for outliers, let's say you're trading 100 markets, how many outliers would there be in a given year? And how big does an outlier have to be defined as an outlier?
All we know, Mark, is that it accounts for about 5 to 10% of our trades. The thing about outliers or these anomalies is they're unpredictable in nature. We can't predict when or where, the frequency, and that's why diversification becomes so important as a primary mechanism to catch as many of them as we possibly can. Because where I think we've got to treat trend following and divergence is there's not a sort of one size fits all across convergent and divergent camps. Explicitly in this trend following world, we are specifically targeting what we refer to as the tail regions of the distribution of returns. So
right.
Our entire methodology is avoiding the noise and mean reversion of the bulk of the distribution of returns. Avoidance. And we do this avoidance by our long look backs. That long look back basically means price has got to do something a bit extraordinary before we even get interested in participating in these particular markets. So now that we've got that system rule in place, we avoid the bulk of trade activity. We only engage in price moves that we believe are material in nature. We're restricting our subset of market conditions to these highly sort of non-linear conditions that are more applicable to tail regions and a Pareto distribution as opposed to the bulk that can be represented by a normal distribution. So therefore, smoothness is not our primary aim here. Our primary aim is this beneficial non-linearity step-ups, and our system risk mitigation is creating this linear distribution of small losses. So we're trying to tilt asymmetry towards beneficial non-linearity with only small linear sequences of losses. That embeds positive skew into it. That's the whole rationale or basis for our approach, because what it engenders in terms of the underlying geometry of the uncompounded return stream of the portfolio is it engenders an uncompounded asymmetry or an exponential function as opposed to a linear smooth function that convergent methodologies need to target, because they're trying to target maximum win, they're trying to target around an equilibrium. We're saying out in these tail regions, multiple equilibrium, there is no single mean, there's multiple standard deviations, it's exotic, a frenetic world that we operate in, high volatility typically, but we want to engender this non-linearity into our uncompounded solution so that when we compound, we get this actual net wealth story at the end that is superior to a convergent, linear, smooth equity curve, if that makes any sense.
Right. Now, if I could just push on this a little bit, because when I was thinking about this outlier question a little bit more deeply, there are a lot of risk premium out there, and most of them are involved in sorting. What you do is, if I'm looking for value stocks or growth stocks or size, I sort, and then I sort of always buy the high decile and sell the low decile. And in some sense, those are the outliers. So is all investing variations on the hunt for outliers? And what makes trend following a unique hunt for outliers? And I'll just throw that out. I don't know the answer.
I personally feel, I feel that trend following fits more into a camp of understanding markets as complex adaptive systems. I don't think terms such as risk premia do any help in our particular world that we occupy, because these alternative methods of risk premia or whatever are associated with notions of causality. We are very much more uncertain about what moves this price. We don't care what moves this price, but we do know that universally in these complex adaptive systems that there is a universal feature of mechanics in operation which can't be explicitly assigned to any particular cause. It could be a variety of different causes, behavioural, tsunamis, exogenous events, endogenous features in the market itself. We can't tie it down to an explicit cause, which I think is problematic, because when you start assigning something to a single cause, you're forgetting the notion of contingent multiple variables that influence a particular event. So if you're only focusing on a single cause like inflation or something like that, that sort of dilutes the efficacy of the event, because that event might have been created by multiple contingent outcomes all affecting things together. So that's why if we look at things as complex adaptive systems and in terms of almost like the physics of mechanics in a complex market, we think that price is really our only guide, and it's the non-linearity or linearity of that price which is important to us, and everything else is fluff to our cause.
We get hammered on it with a tsunami once in 2011. Wasn't there a Japanese tsunami?
Japan tsunami.
Yeah. So, but once again, back to the whole idea that, I think trend following does well with these tsunamis, as long as you don't classify drawdown of open trade profits. We have a tendency to be able to keep losses fairly small, but you can't define a loss as a drawdown. I've got a trade on that has a 300 ATR profit. Now it's 250 ATR profit, and that's a 50 ATR drawdown. If you do that, then trend following can't be perfect in that way. But one of the problems is that in my portfolio, I've made a lot of money in grains, and and they're highly correlated. Some of them went up 50 ATRs, and some of them went up 250 ATRs. So the correlation remained very, very high. And some of it is just, some of the Malaysian palm oil, the bean oil, the oats. Some of it's due to the ATR at entry being artificially randomly low. I threw on a huge position versus the beans or the corn. But I think this is the dilemma. If we're looking at correlation, the whole portfolio is highly correlated, at least that sector is. But some of those outlier trades, 200, 300. I mean, I have on Moderna, and the profit in my Moderna was insane, 500 ATRs, I believe, because System 1 got in when the ATR was 87 cents. So, but it's probably highly correlated with a lot of my other stocks that I made money on as well. So if you've got to sort of say, hey, I love the diversification. I appreciate it. It's great. I have more than anyone else. But if I'm not going to maximize that outlier, make that my tremendous focus and let these profits run, then you're just not going to make as much money.
And except which goes alongside that, when you go from an 87% ATR and you go to like 500 multiple of that, that is now a substantially larger position. And Jerry being Jerry, he didn't vol target or risk reduce that along the way every day. So, he took that Moderna position like a football and ran for the touchdown.
Right. So I'd be interested to ask Jerry and Rich, all of you, interesting question is that we have a lot of equity people that trade momentum. So, and they'll come up with, they could look at, let's say, a very large universe. They could sort, and they're going to buy the, high momentum, sell the low momentum. Do you feel like momentum traders are kindred spirits with you? Maybe wayward children, but are they kindred spirits with you as trend followers?
Probably not, because I think first and foremost, as the title of this podcast, we're systematic. One entry, one exit, a stop loss, maybe a couple more things. I'm okay with that. But if they're pulling momentum out of the sky and influencing some of their trades, but it's not a hardcore systematic rules that they're going to follow all the time. They've done the back tests. It's robust. It's large sample size.
Yeah, and they're doing this is that you could buy it as a swap. Let's say you could buy a swap on the IWM, so the Russell 2000, and so they're and it's all rules based because it has to be in the form of an index. Are they kindred spirits?
I think that they utilize some inherent mechanics that we exploit as well, but I regard them as different beasts. The mob in the momentum camp that choose the top decile and lower decile, to me, that's imparting a bit of predictability into their method, which I would say I didn't really like, because the purpose of our philosophical statement is that we don't predict, we price follow. Whilst people could say, yes, but the rate of change indicator in their momentum models tells me that these are the strongest trending markets, and these are the short trending markets with the strongest rate of change. Therefore, we should bias our process to focus on those two segments. The problem with that is that with our trend following models, we are explicitly cutting our losses short. In our cutting losses short and letting profits run, we are explicitly imparting this asymmetry into our outcome. With these momentum models, say for instance, they're using stocks, the top 20 stocks, because they've got $100,000 and they want to allocate $5,000 per stock. So they've got 20. They are prepared to risk the entire 5,000 of that equity with that momentum move. They won't necessarily have a tight stop in their models like we do, which is to fundamentally create this asymmetry in our process. So they probably are, they're striking at the tail events, but with a different method that I don't think is as clear cut and as robust as our method.
Okay. All right, well, let's jump on to the next topic, which is somewhat related, because as we know, these outliers we talk about, they often happen when markets move, for example, if they're in a bubble. And Mark, you brought up a question in terms of, riding these speculative bubbles, whether we should even care that they exist, and are they just opportunities? And also you kind of raised the question, so to speak, and that is, given all this behavioral finance research that has come on stream in the last, 20, 30 years, 40 years maybe, whether the markets have gotten any smarter, so to speak. So, Rob, you've been quiet for a few minutes. Do you wanna have a crack at this one and give your view?
Yeah, I've been quiet, listening to these guys talking. Has been letting it wash over me. Very, very good stuff. It's for me, it feels like this year has really been the year of the bubble, particularly in stocks, because we've had meme stocks, right? We've had GameStop, we've had Tesla, to an extent you could argue is the ultimate meme stock. Okay, it's a real company that makes profits, but its valuation is completely insane to me. So that, and it's driven really by sentiment, not by anything else. That, to me, that classifies it as a meme stock. And then, of course, you've got the wonderful world of crypto, and not just Bitcoin, but some of the other things. And we've got all these NFTs and Moritz, of course, knows far more about all that stuff than I do, certainly. So I'll let him speak to that. So it seems to say that with all this behavioral finance research, that bubbles are less likely. I mean, I think within individual instruments, we're definitely seeing, bubbles, and you could argue that the S&P valuation is pretty crazy high, really, right now. You could argue the S&P is maybe a bubble. So, I mean, bubbles are just one of those things about human nature that never is going to go away, I don't think. And one of the best things about trend following is that a trend following system is very happy to buy into a bubble and keep going and not care that it's a bubble and just stay in it long past the point at which any person with any sense would throw in the towel and say, look, this is completely insane. Owning Tesla at this valuation is completely and utterly insane. I'm not interested. The trend following system doesn't care about any of that. It just buys the stocks and hangs on. The bubble goes on, the bubble goes on, the bubble goes on, the bubble goes on. It goes on and goes on, it goes on. I mean, you could take, other examples like, say, Japanese government bonds, which, for my entire career, people have been saying we're in a bubble. When the thing eventually pops, because bubbles eventually do, maybe not Japanese government bonds, maybe they'll just carry on forever. But when the bubble eventually pops, you get out. And I think as trend followers, probably we'd be even happier if every single market was in a bubble, because we'd be almost uniquely poised to kind of take advantage of all of these lovely trends that were occurring all over the place, and hopefully not lose too much money when they end, which of course inevitably at some point they will, because that's almost the definition of a bubble. So
what about you, Mark? You brought up the topic.
Well, the issue comes in is that trend followers should be bubble agnostic. In fact, we love bubbles. This is it. And you could say, I love the bubble going up and I love the bubble coming down, because every bubble that goes up, eventually it's going to have to go back the other way. By definition, that defines the bubble. It has to be burst and reversed. So all the issue is that can I get out, maybe you're not going to get out at the top, but you're going to get out at a reasonable price where you still, sort of generate a fair amount of profits. And so it's interesting if more trend followers exist in the market, well, then we're going to get more accentuated bubbles. And so it's interesting is that when people say like, well, the Fed or central banks are creating bubbles, we should love that world. We love those. We love central banks making mistakes that would create bubbles. And is that good or bad? From a public policy, that's a different issue. But it seems as though that trend followers should be bubble lovers.
So we should love the central banks doing what they do so well. Excellent. All right. I'm going to continue to the next topic because we've already gone an hour and we still got a few topics that we wanted to bring up. The next one also is quite interesting. This one was from Rich, and it kind of goes to the topic of change in trend following. You wrote, Rich, the terms used to describe trend following are changing. Traditional trend following has been seen as a naive, simple strategy whose performance has been described by behavioral models, but we're seeing a growing recognition that the simplicity of trend following is a superficial one. Hidden beneath the simplicity is a robust model that is capable of performing in highly complex markets. Today, we're seeing a change in emphasis in explaining how trend following works, with the use of terms such as crisis alpha, outliers, non-linearity, path dependence, non-ergodic process, complex adaptive systems. Is this change in more complex quantitative terminology warranted, or does it compromise the central, quote-unquote, simple message of trend following? I'd love to start with you, Jerry, on this one. We've talked about narrative and stuff like that a lot over the years. So what are your thoughts on this?
Well, I'm going to wait for Richard to correct me on this, but I don't know how I can continue to advocate for a one entry, one exit, and a stop loss and try to describe it as something other than a simple strategy. It can be robust. It can be, you can dig, Richard knows how to dig deep into these ideas and make them very thought-provoking and profound, but still, I just continue to be encouraged to trade a simple strategy. And then it reminds me a bit of the S&P buy and hold, which no one can beat. It probably because it's somewhat systematic, and everyone trying to beat it is discretionary, and it's in the public domain. Everyone knows how it works, just like trend following, which I don't think can be beat either, with bells and whistles, and too much more than one entry, one exit, and a stop loss. So I think we're just in a bind here, or I am, where my conscience dictates me how I should trade and take care of my clients. And I don't know how to, for not to describe it as relatively simple. I continue to trade more markets, and I continue to add, and I do a lot of work, and it's really, getting better and better all the time, but it's really, and then maybe psychologically it's hard to do. It's not simple, taking these drawdowns and taking small losses and a 40% win rate. But other than really obfuscating and confusing people with hiring PhDs, I'm not sure how I could transfer over into a more complex explanation.
No, that's fair enough. Someone who spends a lot of time putting words to paper, that you, Rob. So narrative, I guess, is a natural part of what you do, or at least what you think about. What do you think about some of these things that Rich has raised in this topic?
I mean, I'm a big fan of, I'm happy to use different terms as long as they provide more clarity. So I think there is a big, is the big problem with trend following that people don't understand what it does, or is it that they understand what it does and they just don't like it for whatever reason? If it's lack of understanding and using different words will help, then brilliant. I'm just concerned about whether some of these words or phrases, whether they really do aid in understanding, or whether you'd spend more time trying to explain what they actually meant. So, for example, I'll be completely honest with you. I haven't got a PhD, which is why I don't know what a non-ergodic, did I even say it right, process is. I'm not 100% sure how path dependence, which I do understand, how path dependence kind of goes with trend following. Crisis alpha, hunting for outliers, yeah, I like those. There's a nice intuitive feel about them. I think they will maybe not explain exactly what's going on, but people will hear them and think, oh, okay, yeah, and they'll get a kind of mental picture that will kind of help them to understand the strategy better. So yeah, I don't think we should be coming up with fancy terms just for the sake of it, or also to make ourselves sound cleverer than we really are, right? We don't want to be, just trying to kind of steamroll clients with jargon just to think, wow, these guys must be smart because I don't understand what the hell they're saying. I'm going to give them my money just to be on the safe side in case they really know what they're doing. I don't think that's the path we should be going down. I'm sure that's not what's being suggested anyway.
No, I think that's a fair point. And coming from someone dressed as a reindeer today, I think keeping it simple, hunting for outliers is probably a good place to stay. I want to hear from Mark. I want to hear from you, Moritz, if you have thoughts on this. But of course, we need to hear a little bit from Rich as well. He's brought up a lot of these terms. So who wants to jump in, or do we just want to hear what your experience is, Rich, in terms of this?
I was going to say that there's an inherent need for investors to classify people. Everything in hedge funds, you have to sort of say, where are you classified? What's your peer group for comparison? And whether we like it or not, that's the reality is that because as soon as you go in to see a institutional client, they're going to ask the question, okay, what bucket do I put you in? And the problem comes in is that when you at one extreme, if you have multiple models, it's a hard bucket to put you in. Are you global macro, or you just called systematic? And the problem is that trend following is sort of considered an old term, and it's the correct term, but it's the old term, and people feel is that simplicity is bad. And so I think that part of our job is that we have to constantly tell people that we follow the KISS method, which is keep it sophisticatedly simple, that there's a lot going on in trend following, albeit it can be described very simply. And why is this important? Because you have different people who call themselves trend followers, and in any given month, quarter, or year, they might have radically different returns. And that's an interesting problem from an investor's perspective, because they say, like, well, how do I pick which trend follower when I see that there's such divergence between the performance of one trend follower versus another? What exactly is the strategy? And I think we need to do a better job to describe who we are and what we do.
Yeah, no, absolutely. Moritz, do you have a few thoughts on before we go to Rich?
Yeah. First of all, I think we're doing a very poor job when we speak about trend following, and we use these words such as ergodic and non-ergodic, because really nobody really knows what that stuff is. I mean, you can look it up and then you can obviously understand it and say, okay, I don't want to even explain what it is. I just looked it up. But, you can use simpler words to describe the same thing. And I think that would already help a lot of people to understand it better. What I came to really dislike about the space was that you see these managers in a lot of websites, and then they start with their philosophy, and it's kind of like a full page website with their philosophy of trading and this, that, and the other thing. And you kind of like, you need to have that philosophy. I think it probably takes them a month to come up with that wording so that it sounds really nice. Whereas when you look at other websites, probably the Chesapeake website of Jerry, it says trend following plus nothing. It has the Ricardo quote there. That's it. And that really is it. You don't have to call it systematic global macro and then create a story around it and say, oh, well, I'm kind of like a macro manager, and I'm now therefore long crude oil because there's supply constraints and these type of things. It's just a trend. The flip side of that argument is, if you're brutally honest about it and you just say, you know what, it's just trend following. It is really, here are the rules. I can explain to you how that works. Then the people go like, well, that's too simple. I need something that's better. That cannot work. That must be too simple. And I need to look for something that has more alpha. And then they do that. I'm not sure if there is a way out of this. I think it'll always be like this. I'm now looking at that since years, and have you guys seen it change? A lot of people have tried. We're trying with that podcast. We're just, saying the same thing over and over again. It's like, look, this is how this works. One entry, one exit, one stop loss. And still,
I think people are greedy, and eventually they may come around. They don't like trend following. Then all of a sudden, if stocks quit going up, we have another lost decade. Trend followers and commodities do well. They'll miraculously be born again trend followers. I really dislike a lot of the marketing that goes on amongst the larger firms that, they put in things like, markets evolve, markets change. We're adding machine learning and AI, exotic markets, which I like exotic markets, but it's all of this pretend. And so I stand up and I'm like, you know what? It's sample size, it's robustness, it's one entry, one exit, and a stop loss. It's no vol targeting. Protect that closed trade equity. They don't like that. No, you have other people telling them they can have their cake and eat it too. We'll trend follow, we'll diversify, we'll hit the trends, and we'll have a smooth return. I'll take it. We all went to the same school. And so I like that part. It's not like, oh man, finally someone is standing up and telling us the truth. No, it's the truth that they don't want. They don't like it. And performance doesn't matter. All these guys are tremendously underperforming, as predictable, because they're not following the trends and they're cutting their profits short. And they'll all go down in flames, but never change. I can guarantee you they're never going to change. The clients are not going to change, and we're not going to change. I think that traditional, classic, robust trend following, these days has like a $200 million maximum, whatever Mulvaney has under management. Thereabouts is probably the max that you're ever going to get to. And I don't think that's necessarily a bad thing, honestly. I think it's fine to have a little small business like that. And I had $2.5 billion at one point, but it was inevitably going to be short-lived.
All right, before we get too too far into the topics here. We need to hear from you, Rich, about your thoughts on this. It's clearly sparked a lot of comments.
Yeah, look, my thoughts are, I don't think the trend following community has done themselves any favours by marketing the approach as a simple approach. So I think that trend following has been a victim of the economic circumstance since about the 1950s up to about the 1980s. I believe that in that particular regime, the emphasis that all investors and all institutions and all quants paid attention to was basically the outcomes of Markowitz, Sharpe, all of these aspects which allowed these institutions to put forward these amazingly powerful mathematical models, which unfortunately had no resonance with reality. They are impressive models, but they didn't necessarily explain the alpha that was being extracted from their technique. I personally feel that the biggest disservices to the trend following community has been industry's use of Sharpe, which is this sort of this baggage associated with this economic paradigm. And I also think we haven't done ourselves any favours by referring to our method as simple, because what an investor or an allocator will do is, well, that's so simple. Why would I need to pay a manager to do that for me when obviously it's such a simple strategy that my kids could do it? So I want to invest in someone who can offer something I can't do. And therefore, the two sigmas, the Renaissance technologies, sit up there in lights. And yet there's this huge class of trend followers who sort of sit just below them, 30, 40, 50 of them, who, despite their long-term track record, hasn't got the airspace in industry. Why have they been left out alone, despite the fact that there is a whole class of investors that can produce this validated track record? The term validated track record doesn't even get a mention as far as an allocator's decisions, as far as I'm aware, because otherwise there'd be a far higher allocation towards trend following. So my concern is that I think now the economic paradigm is changing. Post-1980s with the Santa Fe Institute, the likes of Brian Arthur, the likes of Jean-Philippe Bouchard, these people that can explain what we do in terms that recognise that we require this simplicity to trade this complexity, because it goes to work that people like Steve Wolfram's doing in explaining how very complex structures can emerge from very simple rules-based systems. And now we've got physicists and this whole sort of legion of diverse groups, biologists, etc., coming to this consensus that these systems are complex and adaptive, and we have got a method, provided we can define it in the terms that express how our method is superior to other methods, we can then attract investors to us saying, there is a reason why simplicity is good as opposed to simplicity is simple. And when we can sort of explain this argument in concrete terms that actually increases awareness by investors and allocators that there is a specific reason for the models that we deploy, and it is far more nuanced than they might feel. For instance, we sit here together, we debate these things. We're all trend followers, even you, Rob. But, we debate these things, and it's highly nuanced, and yet people probably, if they listen to us, say, well, why is it so nuanced? Aren't they all trend followers? Isn't it a simple technique? We know that these nuances matter. That's why Jerry stands there and argues the case for don't volatility target. And that's why, we shout out, don't use Sharpe, even though we've got Rob Sharpe Carver sitting here in our audience. So these are the things I think are very important to change the narrative, become more sophisticated, because everyone else is becoming sophisticated. We're just going to get left back in the laggards, in the weeds of, oh, that's just a simple technique, unless we shout it out that there is a specific reason now that we can explain how our method, our simple method, actually is very powerful in these complex systems.
If I could just add, I think not trading single stocks hurts the image of the industry because people love stocks and the performance is less. As I told you on the podcast earlier this year, Niels, when I did the back test on single stocks, the big thing that stood out was no increase in performance. It was a decrease in the drawdown. And it doesn't always happen, but like I said, I had some shorts on Black Friday. Yeah. Or you could be 100% long almost every single index if you only traded indexes. So our credibility as a group, that we pride ourselves in not trading single stocks, it's the most ridiculous thing ever. When those outlier trades, those 500 ATR moves are prevalent in stocks, and it's everyone's favorite asset class. I'm all for stocks. It's just not safe to trade them without trend following. And I don't think if we sit right below Renaissance, I'm not sure about that. But I think another missed opportunity is, what does this long-term classic trend following do? What is its one characteristic? When I did the back test, this one thing stood out that no one ever mentions, and that is it makes money almost every single year. So it has a really low Sharpe, but it's reliable. When I was in business, when I first started Chesapeake, I think I had 10 winning years in a row. And with lots of drawdown and a low Sharpe, it was only when I got really successful that I started to try to improve, on just this classic way. And I lost my way. But I think that's another missed opportunity, is who are the traders out there, that substantive organizations that are committed to having drawdowns and maximizing outliers and letting the profits run without regard to drawdowns and OTE? Almost no one. So no one has picked up that advantage of, hey, we kind of suck, but we make money almost every year. And that's out there for anybody who wants it. But I don't see anybody picking up that mantle to where we could legitimately say, we are a great alternative, because once again, all we need to do is be more consistent than the S&P.
Well, that's a great debate, guys. Very interesting to hear your thoughts on this. And by the way, Rich, you mentioned Jean-Philippe Bouchard, who's the chairman of CFM, and all I can say is that we just recorded an episode with him recently, which will come out in early 2022, so in a couple of weeks. And I will say it's the most high-level conversation I've ever heard. I did not do the hosting for that conversation, way above my pay grade. But an interesting one indeed. Now I want to do a quick round now, because we've got still a couple of topics, and obviously we are running already at an hour and 15. So a quick round just to give people an idea of how the various trading we've done so far this year, 2021. What's the best market? What's the worst market in our portfolios? Just to give people an idea of maybe that actually we do things differently. So let's hope we're not all going to end up with the same two markets. I'm happy to go first. The worst market so far in my trend following model this year has been the DAX, probably mostly driven by these short-term models. And the best market has been aluminum. So that's my part. Rob, what's been going on? Best, worst market for you?
Best market, soybeans, closely followed by the Swiss stock market index. Worst market, Eurodollars, and heating oil.
Okay, cool. Rich?
Best market, soybeans. Thanks, Rob. Closely followed by, get this one, the CAC.
Wow.
So it's done really well for me. My worst markets has been the pound Swissy, followed closely by the New Zealand US dollar.
Okay, fair enough. Moritz, what's best and worst?
I actually don't have the specifics here, but I can tell you what has worked really well. I mean, I remember the gas markets and the power markets, they have been absolutely wild this year. So energy has been a very good contributor to my portfolio. I do remember lumber as a gift that kept on giving. Actually, I'm now long again in lumber. The cryptos, man, we have to mention those nice digital assets and how nicely they can trade. So they were just absolutely fantastic, even though they're now going down a bit. And yeah, commodities in general. I mean, energies, grains, lumber, and digital assets.
What about the worst
ones.
markets? Yeah, what's been the worst for you this year? Do you remember?
Probably some currency. I'll look it up.
That's okay.
The bonds, actually, I didn't make that much money on the bonds.
Fair enough.
Yeah, but look, I overall, and maybe there haven't been that many really bad markets. I had a great trend following trading year, so I'm very happy about how it all worked out.
Yeah, Jerry, best worst market for you?
Well, outside of Moderna and Tesla, they were the biggest.
Okay. Yeah.
400, 500 ATRs. Rapeseed, 10, and by far the worst is cocoa. It has to be your worst unless you don't trade it. My gosh. I mean, it is just crazy how bad cocoa has been for so long.
Yeah, I agree with that. That's been horrible. Mark, do you have any best worst markets?
Yeah, natural gas and grains on the best. And I'd say worst I would say the one that's most frustrating has been bonds. Given when you see inflation, and everyone knows I'm sort of a closet macro guy, and I also look at trends in macro data, and that one is just I'm scratching my head to understand the bond market right now.
Okay, fair enough. I'm going to jump to the last two questions because just in consideration of time. And I think they're kind of good questions to end up with because they kind of relate to 2021 and 2022 as years. And these were, the first one was brought up by Mark, really. And that's just, what are the lessons we've learned in 2021? What's the biggest surprise for the year? And what is the one decision you wish you could take back in 2021? And you also ask you also ask Mark the question about if you could give yourself sort of 25 years ago some market model advice. So if you don't mind, Mark, I'm actually going to start out with you. You raised a question. You probably thought about these things. What's your advice to yourself, and what's your biggest takeaways from 2021?
Right. I think that number one is that for best advice is respect uncertainty. And just when you think I've cracked the code and understand what markets are doing, I find out that I'm humbled by what they do or don't do. And I think that ties in with what's most frustrated is that if you go back at the beginning of the year, so we were just coming out of the election. We were looking towards vaccination. We were making judgments about growth and what commodities, what other markets would do. And I don't think that it was anywhere near what I expected when you look across the large number of markets. So I'm humbled by uncertainty.
Fair enough. Jerry, biggest takeaways from this year, lessons learned, biggest surprise, something like that. What's your what comes to mind?
I have to admit, I keep learning the same lessons over and over, but I definitely that the markets humble me. This is where it's all about. It's do the trade, buy the breakout. It's all about the markets taking over. When you make the big money, you just realize the only thing you really contributed was doing the trade and not kicking it out of your portfolio. And so I think the markets are the heroes. And I usually, a lot of what we've talked about is we're in a situation where we disagree on a lot of things, but it's usually surrounding when things are going really well and we're making lots of money. How do we handle that? And I like being in a situation where my biggest challenges are when I'm doing really well. I think it's good to remind ourselves that it's not really our fault either, that when we lose money, if we're following the system, because it usually is just going to mean we haven't had those big trends yet, and we just need to commit to never giving up on the big trends.
Sure. Moritz, what are your thoughts on this topic?
I agree with all of that. What I do remember, and that is really so sticking memory from this year, in January when GameStop and AMC happened, and for the first time, really, you saw people meeting on Reddit and a community being built that was just driving markets crazy, forcing the market's hand if that's possible, twisting some short sellers' arm for quite a while. And so this is a new dynamic that hasn't existed before. And it may be there to stay. When you look at where GameStop and AMC are today, I mean, they're still there. Tesla is kind of like in that group. I'm actually not saying that Tesla is necessarily overvalued, because what's the valuation anyways? If interest rates are zero, you can justify a valuation of infinity. But that was a new dynamic that hasn't existed before. That has had implications on really everything. The stock, the options markets, all of that. So I found that very interesting. Has nothing to do with my trend following system, of course, but it's something that was just amazing to see.
Yeah.
Other than that, I just always focus on reducing unnecessary complexities wherever you can.
Sure. Absolutely.
All the time.
Rich, what are your takeaways from lessons learned?
The biggest surprises of the year was the amazing performance of the classic trend followers over the last 12 months. They have just lifted to the skies. I was also very surprised by, whilst we may feel that we're trading uncorrelated portfolios, do not be under the apprehension that correlations can't change on a pen. And I think Black Friday taught me that lesson. But it was really just the same thing as what happened in March 2020 as well. These correlation just flipped. But another big surprise for 2021 was Winton's announcement that it was coming back more to trend following, sort of starting to refocus its attention back to trend following. I got to love that, because I did miss them so much as they ventured out into that world of convergence, but then they've come back home, which is good to see. The things that I would have taught myself 25 years ago is don't attempt to reinvent the wheel. Use the track record of the validated fund managers as a basis to make your assessment about which technique is the best or which to apply. So stand on the shoulders of giants. Don't do all the hard yards yourself. There's huge experience sitting in these 6 rooms here across the world, or these 5 rooms. I'm excluding myself because I'm a very modest guy. There's a lot of capability here that we can learn from, and people should be doing that. The other thing is start young with trend following, as your performance is measured in decades, not years, it's decades. And don't be fooled by convergence. Despite the temptation and the lure, keep away from the things that Rob does speak of sometimes. and the other thing is embrace uncertainty and embrace volatility of your equity curve.
Nice one. That leads it very nicely into you, Rob. What's your takeaway?
I don't know. I mean, I might be wrong with my math, but I think I'm about 25 years younger than Mark. So his advice effectively is advice to me right now. Yeah, I mean, I'm a bit younger than you guys, except for Moritz, of course. So 25 years ago, the best advice to give myself would probably have been related to women and which drinks to mix or not to mix. But if I had to give advice to myself slightly, maybe 20 years ago when I was first getting into this industry, I think the idea of understanding and uncertainty is definitely right up there. That's a lesson I've had to learn again and again. And this year I've also had to learn again the what Moritz said about reducing unnecessary complexity. I've added complexity to my system this year, but I've also taken some out, because I always try and keep the amount of complexity level. I mean, I'm always trying to look for things that can be simplified, although I realize I don't always give that impression when I'm talking on the podcast.
Okay, cool. So for me, I mean, I'm going to keep it super short. I mean, for me, I guess it was this reminder of the power of simplicity, like Rich talked about. I mean, seeing some of these classical trend following models do so well in the last 18 months, I think that's been a great reminder. And the other thing actually is what we've talked about earlier today. It's turning this idea of diversification around a bit, because I have been a little bit hesitant, as Jerry kindly reminded us in part 1, about how much value does adding another 50 markets really do. But if you think about it in terms of hunting for outliers, I have to say that there's a lot of value in that, and that's really something that I've taken away from this year. So thanks, guys, for all of that. Now, final topic, and I'm going to come to you first, Rob, since you brought up this topic as a question, and that's New Year's resolutions for 2022. What do you have in store?
Well, some of them are things from last year that I still haven't managed to do. So spend less time on social media is one, and anyone who follows me on Twitter will know that I've failed yet again to do that. But anyway, I've got a book to finish, so that's kind of a New Year's resolution stroke ambition for this year. Thing I need to do, and I think last year I did a lot of stuff. And what I really liked was when Moritz said he spent a lot of time thinking about some changes he was going to make. I think next year I need to spend more time thinking and less time actually doing. I think this year the ratio has been a bit unbalanced, and maybe that's because I didn't really do much for my system for the last 7 years, and I kind of made a lot of changes this year, but perhaps didn't spend enough time thinking about them. So definitely more thinking and less doing next year.
Fair enough. Well, inspired by Moritz's approach, Moritz, what's your any New Year's resolution, so to speak?
I don't have any yet, but it's not a recipe that I strictly follow, Rob. I mean, this stuff just happens when I mow the lawn and do random things, and then I start thinking about trading, as we do. Kind of weird, but I love it. I don't have any resolutions yet for the new year. I hope COVID will get out of the way, and we'll have a more normal setting around us, travel more easily, and see friends again more regularly. Just be a nice person and follow the rules. Have a good life. Yeah.
Sounds fair enough. Rich, down under.
Yeah, look, I'm going to sort of follow in the steps of Moritz. I think there's a couple of things he's clearly doing which I need to get my head into. So that's focusing on these emerging markets like China, crypto, digital assets, ESG, space technologies, all of these things. So I want to hunt for outliers, but I want to look at new novel ways of targeting more and more of these outliers. And the other thing I'm very intrigued by, Moritz, is the creation of these synthetic markets. So Jerry and myself on Clubhouse, we've talked about this at length, about spread trading, how and Harold de Beer mentions it as well as a basis to generate these unique trending models that, so for instance, when I look at my portfolio, it's heavily denominated in US dollars. And that does, therefore, create increased correlations within my portfolio when things head south. Everything seems to be denominated in US dollars. I want to spread that, and at least it's going to be research into those areas that Moritz has clearly got his head into, and I'm always late to the party.
By the way, I think I probably need to give Harold a call about this. But when we had him on the podcast, remember, I think it was Jerry, Niels, and I, and we spoke a little bit about these synthetic markets. I don't know exactly what they're doing there at TrendStrand, but I must say that I have a lot of respect for their track record and their numbers that they produce. I suspect that what they're doing with synthetic markets and the way they create these spreads is different than what I do. I had a thing in my head that I wanted to implement, which is probably not what TrendStrand are doing. So it's probably a different thing.
Yeah. No,
we need to bring Harold on, and the six of us just jump on him and
grow a beard first.
Absolutely. Mark, what are your thoughts, your resolutions for 2022, if you have some?
Well, during the pandemic, I probably spent a lot of time trying to learn machine learning and sort of new techniques. So you're locked away, so you try to work on the new techniques. And I do, like, from this conversation, other conversations I said, is that you still maybe have to say, how do I strip down complexity and move to simplicity? So it's always good to sort of say that we'll call it the New Year's resolution. You want to clean closets, sort of do some housekeeping. The housekeeping would be, say, like, am I going down the path of too much complexity, and how do I strip things down, throw out some of the excess?
That's fair. Jerry, what are your thoughts for next year?
See, I'm going to continue my quest of adding more markets. I'm doing it by looking into different stocks and ETFs, uranium, cobalt, lithium, rare earth metals. So just continuing to find more, hopefully different types of stocks and commodity-based stocks. And I'd love to get involved in China. That may be something that's too big a hurdle for me, the China commodities, but I'm really just going to continue to push to 160, then 200 markets. So I think Quantica wrote a paper recently saying 200 markets is kind of optimal for trend following. But I've always liked trans trend. I gave the spread trading a go. I'll never give up on that project. I couldn't make it work. But they've always been my favorite. And so maybe one of these days, the holy grail is spreading these markets and creating 1,000 sort of synthetic markets. But I haven't been able to make that work yet, but I'm not going to ever give up, probably.
Fair enough. I think that's pretty much all the topics that we had more planned, but we also have some time constraints. Of course, we've been going also for part 2 for an hour and a half. So I think I'm going to wrap up this epic conversation that we've had for this year, and it's going to appropriately end the year, being published in the last 2 weeks of 2021, so to speak. I hope that you have enjoyed last week's part 1 as well as today's episode. If you did, please head over to iTunes, leave a rating and review so more people can find the podcast, and make sure you follow the podcast as it's now called. And of course, make sure you tune in to the new episodes coming out in 2022, including a new series, by the way, or a new segment in the volatility series. Next week, we're back with the usual format, so make sure you join us. As usual, send us your questions to info@toptradersunplugged.com. My sincere thanks to all of you guys, Rich, Mark, Jerry, Moritz, Rob. I mean, we couldn't do it without you guys. So my big thanks to you. And of course, to all of you who have been listening to us talking about trend following this year. From Jerry, Rich, Rob, Mark, Moritz, and me, thanks so much for listening. And we look forward to being back with you next week. Until next time, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.